Hello and welcome to the weekly market view. It's myself, Simon Brown, and Bill Hubard, very kindly joining us. Thank you, Bill. Bill, I'd like to start on interest rates and central bank decisions that have been made today. Bank of England says that it's not going to increase quantitative easing. We saw the pound rally. We saw the ECB keeping rates unchanged. What's your view on?
Well, I went in today's moves feeling that what happened both with the ECB and the Bank of England, that's what I was calling for. I was expecting no change. But the interesting thing is that if you looked at the Bloomberg and the Reuters surveys, a lot of the economists were sort of hedging their bets, and they were the ones saying there was a real possibility. And yet, it didn't seem until probably mid-afternoon yesterday that the traders said, because we'd seen no real move, in either sterling or the euro. But all of a sudden, yesterday and this morning, we saw, again, 2.5-year low on sterling. We saw euro trade below 130. So the traders will say, let's hedge our bets. As soon as that happened, we went back to pre-announcement levels.
So this little pound rally, it could be a blip?
I think so, because I felt that the bank would do nothing before the budget on the 20th of March. Otherwise, that would have been a little bit too political. I am still expecting at least 25 to 50 billion in QE, probably in the second quarter.
Okay, and European interest rates have been staying at 0.75% for a year and a half. What do you see, throughout the rest of the year rates-wise? Do you think we are going to see that?
Yeah, I'm still in the camp, and I started this year. Okay, although I got a little dubious when the euro February 1st 137 plus, and now with the trading at say 130. I think what we'll see from Mr. Draghi today, more so discussing the strength or weakness of the euro, but the key thing which should allow him, which I expect at least one rate cut, probably mid to late second quarter, with they will both reduce growth and they will reduce the inflation forecast, which will allow them at least one more rate cut.
Okay, interesting. Just moving to the indices, we see that Dow Jones is sort of pushing new highs. Nasdaq possibly lagging a little bit behind. Can you talk about that sort of divergence?
Sure. I think one of the things that the thing we have to look at is the Dow Jones is only 30 companies. Okay, I know it's been around 116 years, but when I started, in 1971, 5 of those 30 companies, 3 were railroads, 1 was a steel company, and the other one was a FW, okay? So it really doesn't give you a true picture of the U.S. economy, where the NASDAQ does. The S&P, of course, we're well above that 1,500. I don't know what percentage we are down on the NASDAQ, but I think that the key thing that I'm looking more towards is the rotation now from Apple to Google. Okay? I think that's what people are really looking at, and I think that could give us a good indication. But earnings are only average earnings is only like 2.5%. You get 2% on the Treasury 10-year. So what I expect to see is more and more of the gurus, which I'm not. Okay, I'm just good looking. I ain't a guru. But more and more of these gurus start to say, well, wait a minute. Are we going to see 82, 84, 87 before all, the big movements before a crash? I'm not expecting a crash. I do expect that once we get into the next quarter, you could see again some profit taking.
And do you think the shift, from Apple to Google, is Android a big catalyst for that?
What?
Are the increasing use of Android devices and their almost dominance of the smartphone market, globally, do you think that's partly responsible for that?
My mobile phone has died. Okay, so I'm not the one to talk to, about anything in the 20th century, much less the 21st.
Okay.
I think what we will have, and we even had one of the guys from Google in one of these, IT seminars or something in Southern California last week, was basically saying even he is almost embarrassed, ashamed that everybody spends all their time sending emails to each other, and what we're doing, like talking as human beings, sort of dying out. So I thought that was quite interesting, his point. And I think we are going to have to reach a point of how many mobiles can you have. But I would have to say on Moorgate the other day, I did see one person with 3 mobile telephones. Okay?
I'm always suspicious of some of them. Excellent. So just finish off on equity markets. My personal opinion is that there's still a yield to be had on some of these stocks, and with not a lot of other options for investment. potentially we can see the stock market to carry on grind higher.
And I think one of the things that we have not seen, okay, I know we've seen a rather sizable sell-off in commodities, but I mean, if some of our viewers, if they're around from like 2002 to 2008, you know, 7, 8 of the top performers on the FTSE 100 were all commodity-related stocks. None of these are moving at all. So if we start seeing, whether you see social unrest or the cost of getting the end product out there, could we then start to see, if the market feels, let's start seeing gold above 1,700, and platinum and palladium, et cetera, therefore we could then have the area that is not moving, in the global equity markets, which are the commodity-related, mining-related stocks. If we start to see that move, yes, we could see a massive continuation, because all those stocks truly are undervalued.
And you know, with new highs being reached, I mean, the FTSE, I think, must have been 2000 when it was up at 69.50, but that feels like it's a real target.
Yeah, I think it is.
And just touching on, just read a piece about John Lewis actually, and they were paying 17% bonuses they declared, and you know, is that John Lewis saying that we're pulling out of this retail slump? You know, that are they just overly confident about the future?
Well, two things I think. One, maybe just for some of our viewers, you know, John Lewis is a co-op, so each of the employees own. So the harder the employee works to basically sell their John Lewis products, it goes into his or her pocket. And also, I think John Lewis, unlike, and I don't want to say like Debenhams, John Lewis is one of the early stores to go into the .com boom. Okay, to start doing online trading. So they're seeing that. And I think one of the things that's helping them is the simple fact is, you know, I live in Wiltshire, and I mean, we're talking Swindon, Reading, and Bristol, okay, which are distribution points. And I mean, literally, if I'd ordered something early this morning, there was the real possibility it could have been delivered this afternoon. Now, if you live in London, it's, don't know whether we could deliver it this year or not. So I think that's what's helped. So they have been able to reduce their physical building cost, okay, and put it into either salaries or inventory, et cetera, et cetera. So I think it's a positive move, because we will start to see the retail. But again, on the converse side, you know, with the Thomas Cook announcement yesterday, what's that going to be? Another 2,600 stores. So the high street is going to continue to come under real pressure.
Yeah, that is interesting. We see retailers suffer, big time from not having an online presence. But I still wonder whether, there's still a good percentage of the population just likes to go out there and touch and feel.
Maybe I do.
I think maybe our wives do, that's for sure. But it's just it's something about touching and feeling something.
Exactly.
That maybe it always has a place.
Well, my wife just ordered something, which they're even prettier. She ordered some, some comfortable, like loafer type shoes. And I mean, I think they were classified as being pink. Well, they came in a lovely lavender. Well, we'd have seen that, okay? As you say, in the store, okay? I don't care what they wanted to call it. We would have known exactly what they colored. And I think maybe, again, speaking as an old timer, I'm like you. I want to see it, I want to smell it, et cetera, rather than sort of page38.com, et cetera.
So I think this year's going to be quite exciting.
Yes, I think too.
If equity markets are feeling okay for the moment, and rates, we may see a change towards the end of the year. And I think it's pretty positive for the trading environment. Brilliant, Bill. Thank you very much.
So keep trading with Capital Spreads.